Good afternoon. Let's get started. As I said, good afternoon for those of you on the eastern side of the U.S. and good morning for those of you on the western side of the United States. Today's webinar is Risk Management in the Digital Age. My name is Randy Sadler. I'm a principal at CFC Services, and I'll be your host today. Honored to be with you. I would ask if you would keep your computer phone on mute unless you're asking a question, and you can type your questions in the chat bar. So let's dive in. This is my background. My name is Randy Sadler. I'm a principal here at CFC Services. I always tell everybody that I learned risk management in the Army. I went to West Point. I graduated in 1992. I was a tank commander 5 years, responsible for the safety of soldiers with fuel, ammunition, moving large distances. So it's really where I learned risk management. And I've been here at CFC Services for right at 10 years. So that's my background, and I'll be glad to send these slides to you as well. A little bit about our firm, CFC Services. We are what's known as a captive manager, which means we help businesses set up and own their own insurance company. Some of the things that we help businesses do is establish asset protected loss reserves, increase their profit or wealth, generally by millions of dollars, lower and control insurance cost, insure uninsured or underinsured risks. COVID-19 would be a classic, and then really benefit from insurance company tax treatment. So all of those benefits roll up into sort of a total financial package of owning your own insurance company known as a captive insurance company. Now, it's quite possible that you have seen us in the news. We have been making some headlines. CFC Services sued the IRS over a notice they issued back in 2016 called 2016-66. That lawsuit made its way all the way to the Supreme Court, where we won 9-0, and then the court was then remanded back to the district court to determine what the consequence would be for the illegal notice 2016-66. And so the notice was in fact vacated by the district court in March of 2022. So we're very excited about that. You can read it many places. Business Insurance, Forbes, Accounting Today, Yahoo, National Law Review, Wall Street Journal covered it. I mean, it's everywhere. So, but anyway, our firm is definitely one that makes headlines, stands up for the industry, and stands up for business owners who are seeking to protect their business by owning a captive insurance company. And with that, we did win Captive Manager of the Year last year. We're very excited about that. By the way, this is U.S. Captive Review Awards. Captive Review is one of the larger publications in our industry, and we have been a finalist many years, but we're very pleased to get the nod in 2021, as they say. So let's talk a little bit about understanding what we're going to call emerging risks in the digital age. And today's topic is actually largely built around an article I wrote a few months back, and I'll send you the slides. You can link to there's a link right here to go to that article. So feel free to do that. But it's published in Treasury and Risk. Treasury and Risk is a fantastic publication, often used by corporate finance teams, controllers, and as well in Treasury departments, to really think about how to manage, obviously, the cash flow and funds for corporations, but also thinking about all the things that threaten a corporation's livelihood, if you will. So I'm really pleased to have this article published. Would love to send you a copy of it if you'd like. I can send it to you as a PDF, and you can read through it, but it's going to guide a lot of our discussion today as well. So you might be thinking to yourself, of course I would, I thought we already entered the digital age. Well, we did, but the pandemic really accelerated it. In fact, in about a 1.5-2 year period, technological advancement increased by 7 years, according to a McKinsey Global Survey. The link's below. I can send it to you. The point is that the pace of change is really accelerated. This creates a unique problem for insurance. If you're familiar with the insurance space, most insurance does better when it has a lot of data, right? So it's very easy to price car insurance, for example, right? Because we know we have a lot of cars on the road. We have a really good idea how many you're going to wreck, how often, how the weather affects it, et cetera, how the driver, their age, all of those things affect the number of accidents and what we should charge for insurance. However, if you think about how rapidly technology is changing, it's very hard for insurance to keep up, to know the likelihood of a loss, and to know what should I really charge for your insurance policy. Okay. So is the pace slowing down? We said that it's sped up, basically covered 7 years in 2. Well, it doesn't appear to be. So in 2022, the digital economy continued to grow. IDC projects that by the end of this year, 65% of global GDP will be digitalized, nearly $7 trillion in investments into the IT sector through 2023. So the digital pace doesn't appear to be slowing. In fact, it appears to be picking up. So what are emerging risks in the digital age? And these were focused on in this publication. Well, the first really is lawsuits, often due to negligence, potential negligence in remote work or diagnoses. There was a really interesting case where a psychiatrist who diagnosed a patient via questionnaire over the internet versus meeting in person got the diagnosis wrong. This is the case of Haggeseth versus Superior Court in Colorado. And the psychiatrist was sued, and that case is winding its way through the courts. So, going remote, going virtual opens up a whole new range of potential lawsuits, not just in medicine, but any field where decisions have to be made. A diagnosis or a professional decision has to be made. So that's an important one. The second is AI. Artificial intelligence, which I'm sure you're familiar with, but more importantly, the failures caused by, budding AI or AI that's sort of in development, getting its feet under it. As many of you probably know, an Uber self-driving car, for example, ran over a pedestrian in 2020. Uber wasn't criminally negligent in that case. However, they did pay out a very, very large settlement. So there is a price that comes with AI and what that's going to cause. I mean, just think about AI going into other parts of your life. Example could be your security system. It could be something running your home. As that progresses, that AI, as well programmed as it may be, is going to make mistakes, and when it does, it's going to result in risks. Now, certainly businesses are adopting more and more AI, and that's going to cause risk for them as well. Corresponding with AI is robotics. We're seeing more and more robotics in business, in manufacturing, in a wide range of industries, and robotics is causing challenges as well. Boeing recently, that they had a kind of an ambitious plan to use robotics predominantly in their 777 assembly line, and really had to transition away from the robots for a period of time, go back to more of a manual way of doing things. But robotics creates a lot of risk as well. And probably the most important, especially in the last few years, is cybercrime. So cybercrime doubled from 2019 to 2021. That's kind of a mind-blowing statistic. And we don't even have the numbers right now, but it must be higher. It's certainly a lot of this driven by international incidences. You've got obviously Russia invading Ukraine and threatening to really step up cyber attacks against the U.S. Because of hostility and really an anger about how things are going. So what we've seen, though, because of remote work, we've seen largely because of remote work, cybercrime increased significantly. With employees working at home, there's certainly some benefits to that. Maybe they're happier, certainly during the pandemic, able to potentially avoid catching COVID, or at least to flatten the curve, as we were told. Nevertheless, with many people working at home on their home networks, that really home Wi-Fi, if you will, that opened up some serious risk. You can read about this in Cybersecurity Ventures. in the cybercrime diary. So these are all really good data points to work with. So let's just kind of thinking that sets up the problem, if you will, but let's take the next step of things that companies can do. And this is small, mid-size, even large corporations. But we primarily work in the middle market, so this is a good time to pause and really think about the business as you move forward. I mean, the first thing to do is to conduct a technological risk assessment. What kind of risks have been created by new technologies you've brought in, or technologies that you already had that you really hadn't thought about the exposures they've created for you, and try to map those in terms of probability or frequency, if you will, and then the potential severity. So that's an important first step. When we work with a client to help them own their own insurance company, our first step typically is to work with them to bring in a third-party independent risk assessor that's going to really think about all their risks, look at it by industry, look at their technology types, look at their people, and then do this exact same thing, plotting each type of risk by probability and severity. So very much an exercise worth doing. And then the second thing really worth doing, especially as I mentioned earlier, that a lot of commercial insurance just isn't keeping up with evolving risks, is to really evaluate the company's insurance policies. A lot of businesses think they're insured when they're not. We saw this during the pandemic. It wasn't necessarily technology related, but many businesses thought that they were insured for business interruption when in fact they were not. And the reasons were quite simple. Many of them had policies that had virus exclusions in them, interestingly, and many also had policies that only triggered business interruption if there was actual property physical damage. In most cases, courts have ruled there was no physical damage. There have been a couple courts that argue that a virus was a physical damage, but for the most part, the insurance companies have won, and many businesses have had no business interruption claims paid. So this is important. Evaluate what risks am I really insured for in my business, which ones are not, and things that are clearly not covered. In my insurance policies, what exclusions exist? This is really important because it may look like you're covered for cyber crime as an example, and then there may be an exclusion for human error. Well, for most small, mid-sized businesses, if you're going to have a cyber event, it's quite likely that somebody on your team is going to open the door accidentally or make a mistake, right? And I think the last one is really important. What risks are in a gray area? And the policy language may be a little gray. You're not really sure you're covered. There might be a way to wiggle out of paying you if you get a loss. Ask for clarification in writing. Reach out to your insurance broker. Press them to get the carrier to commit that you would be covered under those circumstances. So that's very much worth doing. All right, number 3 is analyze your organization's security measures. So this is a really important step. Just to really take a hard look across all the organization's security as it regards technology, and then put either procedures or mechanisms in place that mitigate technological risk. So that's really important. Things like really making sure you've got secure Wi-Fi. Example would be, when employees travel, have them use a hotspot versus just jumping on hotel Wi-Fi, which can easily be, can be mimicked by someone in the lobby who can set up a Wi-Fi and have your employee log on, and they think they're on Wi-Fi and they're not. They think they're on the hotel Wi-Fi. They're actually on somebody else's Wi-Fi who's watching everything they do. So it's really important to assess. That was just an example, but assess procedures and mechanisms. And then really implement a disaster recovery and continuity plan. This is really important with new technologies. Evaluate, can a threat be isolated or cut off? So, as a really simple example, backing up all computer systems every night, being able to, in the event of ransomware attack, for example, being able to completely shut down the entire system and then reboot to just a day ago, as an example, can be a way to just restart, right? Can systems be shut down and restarted? And then are your manual systems adequate to buy time? And in many cases, it's really worth doing a trial run of those. Obviously, you don't want to disrupt the business, during the peak season, but there may be times when you can test manual systems and make sure you feel confident they'll get you through when you need them. Now, this isn't going to surprise you, but we're going to also talk about captive insurance. And number 5 really is to consider supplementing commercial insurance with a captive insurance strategy. Now, this is really interesting. According to Aon, cyber risk, and Aon is a huge global insurer, cyber risk coverage in captive insurance companies increased over 650% in the past 5 years. That's kind of a mind-blowing stat. And what it tells you is, and this is fueled largely by larger corporations, but what it really does tell you is that captive insurance, owning your own insurance company and insuring risk through it, may be one of the best ways to address these emerging, ever-shifting risks. Captive insurance can write policies that are unique and tailored to kind of the uniqueness of the business. And they can also write policies with far fewer exclusions that are more likely to be there when you really need them. And that's going to be really important for a lot of small and mid-sized businesses. So let's quickly understand captive insurance as we're thinking about technology risk. Just in really simple terms, a captive is a real insurance company, typically owned by the business, a holding company, or the business owners or related entities. Captives generally insure the businesses or related entities. Could even include things like franchisees as an example. They've been around since the 50s, so they're not new, and that you'll find them just about in every sector of the market. What they do is everything on this page. Replace your commercial insurance coverage or replace part of it. Insure what we call enterprise risks, often uninsured or underinsured. They can insure warranties. They can do bonding, employee benefits, healthcare, and any combination of these. So they're a very powerful risk management and financial vehicle. And in really simple terms, a captive structure looks just like you see here. Business or businesses on the left, captive insurance company on the right. Typically the same owners that own the business own the captive. The business pays premiums, transfers risk to the captive, and issues insurance policies. Back now, when we kind of pause and think about this, you might say, it looks like I'm taking all the risk. Well, normally we're going to backstop this captive in some way, and I'm going to cover that in a few slides. So you're not just out here by yourself protecting your business, if you will. Captives are a form of alternative risk transfer, and alternative risk transfer has been growing in the commercial market space. You'll notice that 56% of really all risk arrangements in the commercial space involve some form of alternative risk transfer. This can include things like captives. It can include pooling, risk retention groups, and in some cases trusts as well. Forbes actually indicates that 90% of Fortune 500 utilize alternative risk transfer through a captive program. So they're very common in the larger corporations, and they're really growing in the middle market. And this is a little dated, but nevertheless, you can see what industries are using captives. And interestingly, financial institutions on the left, manufacturing, healthcare, technology, education. As you scroll through this list, you realize many of those that have the greatest technology risk are on the left. So that makes a lot of sense, if you will, that they have a lot of exposure, and that they have, it makes sense for a captive to cover the risks that they have. Now, remember, I mentioned that, when you have a captive, you're not going to be out there all by yourself. Normally, captives are involved in some type of risk layering. That's the way to protect the captive, protect the business. You see here, we're showing what we're calling a captive retention layer, where the captive is taking in this case, a $250,000 limit per occurrence, and then $1 million limit aggregate. and then we're passing that rest of that risk on to a rated reinsurer in this example. So captives typically spread out the pain, if you will, by sharing it with reinsurers or co-ops or pools, which I'll show some examples of that here. So this is one example of how to spread the pain. This is a traditional fronted reinsured captive insurance company. A fronting carrier is typically a rated insurance carrier that has been admitted to write in the states the business is operating in. It issues the insurance policy, but then reinsures that risk in most cases to a captive who reinsures part of the risk to a typically rated, not always, reinsurance carrier. That structure might look a bit like this, where we have the shareholders who own the business or businesses are buying insurance from a rated admitted fronting carrier, which is then transferring either all or most of the risk in many cases to a captive insurance company, which is then reinsuring part of that risk for, say, large losses to a commercial reinsurer. In this structure, by participating in their own risk, the business is able to write unique policies that can address their specific technology risk, get an reinsurance carrier that's willing to back those unique coverages. And by participating in their risk, it's much easier to get a carrier to participate as well, because they know that the business has skin in the game, or the shareholders have skin in the game. And so this is a great structure. If there are no losses, the profit in the captive is retained, which is very powerful. Rolls over from year to year, provides more insurance protection. One option for a smaller mid-sized company that isn't large enough to attract a commercial reinsurer or a front is really just to take a high deductible on their technology risk, whether it's their cyber policies or other policies that are impacted by technology. You see here, we have shareholders that own the business, own a captive insurance company. It's sitting under commercial insurance that may be rated or admitted if required. So that captive is picking up that first layer of risk by taking a high deductible, hopefully able to control some of their insurance spend here. And then one of our structures that we like, it's very exciting because it provides fantastic reinsurance, is a pool arrangement, which is a bit like co-oping. And so in this case, the shareholder or shareholders own the business, or businesses own their captive. They pay premiums and transfer risk to their captive, which issues insurance policies. And that captive reinsures risk into a pool. That pool shares risk with other captives owned by other business owners that are similar. In this structure, we're showing 100 insurance companies sharing risk. So it may look a little like what you see here, where imagine that there are 100 captives all sharing a little bit of risk with each other. And so what would happen if you had, say, a cyber breach and it cost your business, several hundred, let's say $400,000 to address it, and you weren't insured commercially, but you were insured by your captive insurance company, the business would file a claim, assuming that claim's approved by a third-party administrator. The captive would write a check for $400,000 to the business to address that loss. Now, the captive has had a few years to build up that money, hopefully, and taking advantage of insurance taxation. And then the risk pool is going to reimburse the captive $200,000, or half the loss in this case. So a big help at the time when the business had a big loss. If you'd like a copy of the slides I just covered today, it's got all the links in it. And I can certainly send you the Treasury and Risk article on risk management in the digital age. Just send me an email, randy@cscservicesllc.com, and I will be more than happy to send everything to you. And I hope everybody has a fantastic rest of your day.